So what does the M&M model have to say about dividends? Okay, now the M&M model, if you recall, doesn't always have the most realistic assumptions. So in this case, what they've assumed is that there's no taxes and there's no transaction cost, meaning it doesn't cost anything to buy or sell shares. That one might be true nowadays because you can essentially buy things for free. However, taxes do exist. But if we took taxes out, the conclusion is that dividends are irrelevant. And what they essentially say is you look at the two following scenarios. So scenario one is shareholder wants dividend, and the company does not pay. Okay, so a lot of companies do not pay. So for example, like Tesla doesn't pay a dividend. What if a Tesla shareholder wants a dividend? The conclusion is that they should sell a proportionate number of shares. So that is reasonable if there's no taxes. Now, even if there is taxes, you could say that still makes sense because the person was going to pay taxes even if the company declared the dividend. Might as well at least not force everyone to pay it. In this case, the only person paying it is a person that needed the money. And scenario two is the opposite. So shareholder does not want the dividend. Okay. And the company is paying. So what do? They essentially should reinvest. So instead of taking the cash, take it and reinvest it. Canadian companies do have this. It's called a DRIP, Dividend Reinvestment Program. So if you choose to do so, you can automatically have your dividend used to repurchase shares, and it'll purchase a fractional amount. The problem is you still do pay tax on it, so it doesn't get over the tax situation. Now, the next part of it is so that's M&M models, but we've talked only about the regular dividend so far. And what that regular dividend is, the quarterly dividend that's paid no matter what, because shareholders want stability. There's another policy called a residual dividend policy, which does make sense. Okay? Because what it says essentially is you use your cash flow for all positive NPV projects. And then whatever is left is paid as a dividend. So anything left paid as a dividend. Makes sense because you definitely want to be using the cash for positive NPV projects, and you don't want to pay out cash if you have profitable projects. The problem with this, though, is why do companies not use it? Is that the amount will be different every year. Okay, so it'll depend on A, how much you earn, and B, how many profitable projects you had that year. And it could be a year where you say, well, we had a lot of profitable projects, so we're not going to pay any dividend. Shareholders aren't going to like that. And the real issue is shareholders who are buying shares of a dividend company, they want stable dividends. And that's why most companies tend to adopt a stable dividend policy.